What's up,
Hello?
man? I might do it in Naps's channel as well, actually, so everyone can ask questions. Whoever wants to come. You good with that?
Yeah, as you wish.
This one's just a core content one. It's not a core content one. It's just a risk management lecture. Let's hop in that voice.
Alright.
All right.
How's it going?
Not too bad, man. How was your day?
Good, good. You saw I was short biased and eventually it went shorts
Yeah.
from that
Today was
minute.
today was like probably one of the choppiest delivery days I've seen in a while.
Yeah. We printed some equal lows, so who knows?
Yeah. After like seeing the morning session just like completely chop all day, I was like, okay, today is gonna be a very choppy delivery day, just because it's low volume and right before the holidays. But we printed equal highs and we printed equal lows, so it was kind of a 50-50 as to where price was going. If you see though, price came right back into that true week, true day where it eventually bounced. I think it was also a 4 hour fair value gap.
Mm.
It was it was a 4 hour. It was a small 4 hour fair value gap inside that bigger one. It was two, and then yeah, it repriced true week, true day, and then just closed the day back. Did it? I wonder if it closed back in the TGIF range. Anyone check that?
Yeah, I can check.
Yeah.
Just
Close rate at 30%.
Really? Did it actually?
no.
Pretty much.
So that's like a very
Point
so this week might have been. I mean, I wouldn't say it's a classic bye week or sell week. It was just like an inside week. Did you drag your Did you drag it from the Wednesday high to low or low to high?
dragged it from low to high.
Yeah. Let's see.
It's in the 60s zone. 67.
Oh yeah. It actually it closed right at. Yeah, it's interesting. That range was a very interesting pivot today. Okay.
You recording this one of these?
Yeah. It's streaming on YouTube, and then I will publish it for you guys after. I'll put it in the channel under lesson recaps. I'll make a new tab like I have under the education tab. I'll make a new one and put it there for you guys. Okay, so risk management and psychology. Let me share my screen. There's also the YouTube thing, but that's just for later. Okay, this lecture has nothing to do with the charts, which is something rare for me because usually everything we do is on the charts. So what we can do is we can hide this for today. We can just open up a new thing. Oh my gosh, all the alarms went off. And we can just hide this. Okay, so let's talk about risk management, psychology. And this is something that's very I spelled psychology wrong. Mental, I'll call it that. Okay. Something that's extremely underrated, and I always consistently tell like my students and I tell myself that your model is only successful insofar as it's supported by some underlying risk management. Now, everyone will tell you this, but risk management is something that's widely spoken about and touted as important, but not really parameterized or given instructions to very well. Like you'll hear things like risk 1 to 2%. You'll hear things like only size to lose. You'll hear a lot of these heuristics, but let's actually talk about ways in which you can kind of parameterize and create rules around your risk management. So if you guys look at the lesson structure, there's a couple things I want to cover today. And those are risk of ruin, expectancy, the basic math behind that, and why you should actually care about risk management, and then my personal risk strategies to kind of keep myself in check and parameterize my trades such that I can inflict as little damage in the long term as possible to grow my account. So as you'll notice, there's two types of traders in this world, and the first type is what I like to call, so this is type 1. The first type is like what I like to call a windfall trader. And a windfall trader simply looks like this. You'll see if this is like the zero value of an account, right? So this is your starting balance. You'll see that windfall traders often are good traders with good strategy whose equity curves look something like this. And say this is your max loss right down here. You'll see that windfall traders go through a cycle of small wins or large wins. This could look like that, or it could even look like this, which in worst cases, like this, right? Like small wins and large losses, or large wins and large losses. Ultimately, no matter what, the end result over an extended period of time is this. And if you look at like, you know, equity curves on Apex, stuff like that, you'll find two trends for what I call windfall traders. The first is that their average winner will be equal or smaller than their average loser, meaning they might have like a, you know, 50% plus win rate. However, they might have a 60-70% win rate. However, their RR, if you actually calculate what it is based on this curve, not based on the P&L tool they use that looks like this. Like in their trades, they're going to drag something that looks like this. I'm like, okay, it's a fantastic RR. What really happens in reality is that people, these types of traders, are incapable of taking losses, so their losses turn into like these. So you'll often find they have a negative R on their trades, and the best way to show that, you know, over a period of time is just to look at an equity curve. If you see an equity curve that looks like a staircase up, right, and then an elevator down, this is how you can kind of identify and put yourself in that windfall trader group. And what that comes down to from a psychological level, so if you're a windfall trader, is that you're unwilling to take losses. So let's take a look at what that means. Unwilling to take losses. So this type of trader has a couple things that are, you know, pretty consistent about them. A, they have good strategy usually. In fact, these traders might be what I consider to be great analysts. Great analysts can be very dangerous traders for this reason, because despite having good strategy, they're usually unwilling to sacrifice, right, a trade when it is, you know, invalidated. I mean, when I say sacrifice, I mean literally throw the trade to the garbage and be like, I am wrong. They're unwilling to say, I am wrong. It's something that they don't like to say. So the characteristics of these types of traders, and you'll know if this is you, is these traders tend to have very precise entries. Meaning they will wait, right? They will be patient and wait for their model to form. However, right, when price, and also here's another thing, and very, very good at honoring TPs and managing a trade while green. I'm gonna put that in caps, okay, while in profit. These are the types of traders you'll see, and the reason why I say in profit is because you'll notice windfall traders, in my opinion, right, who aren't just like, you know, YOLOing every trade, look something like this. And this was me when I first started. I could take 7, 8 winning days in a row, but I would limit my upside, meaning I would take strategic profits. Every single day, my trade would hit my TP and I'd be out. So my curve actually wouldn't look like this at all. What am I talking about? It'd look more like this. It looks more like an arc, right? You're kind of going up and you're slowly increasing your equity value each day. You're slowly growing your account each day. But this is capped. Like, I'm not going for huge wins. So I'm not getting these massive $5,000 days. I'm getting these 200, 200, 200, 200, 200. And then, right, so then let's get to the next part. So this is what your curve looks like while you're in the green, while your P&L is going up. This type of trader has one really deadly characteristic, and that is, right, when losing a trade, when a trade is invalidated, this type of trader does this. And you'll know if this is you. The first thing that you'll know to ping yourself this type of trader is you'll average down. And you'll average down using solid TA. Meaning you'll see the side of the coin that supports a bullish thesis. Let's give an example. Today, if you were long, right, off this bounce, you would probably wait as a good trader. Let's say you're trading a lower time frame even, right? You wouldn't just randomly long this low. You would do something like this. You'd wait for, this inverse fair value gap to print right in here. Or you'd wait for this breaker, for example. And then you'd go long in here. Fantastic entry, right? And then you'd be targeting, let's say you're being aggressive. And I took the trade at the end of the day, but let's say you're aggressive and you want to target these highs. That's fine. What you'll do when you realize the price is starting to not move in your direction, you might have taken a trim already, 40 points-ish, but you're still targeting all these highs. What you'll start to do is you'll start to build in additional TA even when the other side of the coin, right, is telling you that you might be offside. So for example, here you can see there is a 5-minute inefficiency. And price is generally respecting that 5-minute inefficiency. If you were bearish, you would say, okay, like that's a good TP. I want to get out of my position, right? We're respecting that gap. But because you have great analysis, you'll find that you'll start to do things like this. You'll ignore this 5-minute fair value gap and then this market structure shift. You'll ignore that. Instead, you'll see, oh, well, there's a fair value gap here, right? And what you'll do is you'll maybe take an entry in here. Right? Another one. If they're averaging up or averaging down. Then you know that the invalidation point for this fair value gap would be a candle body closure below this low. So you'll wait, right? You get stopped up. This is where your mental will go bad, right in this area right here. Because for you now, you've either given back profits that you thought you could have achieved, if you took all of your contracts off here, or you've taken a loss on your average down position. Now what you're gonna do is completely ignore the TA which you use to get into a trade. Look at this. And I know this is myself. This is just a 5-minute market structure shift right below this low, right? You can see candle closes, right? Or even, you can even say that we get a lower time frame market structure shift right in here as well. Now, you know that your long thesis is probably not going to come and get these highs, but you are seeing only one side of the coin, which is, okay, here are my equal highs, right? How many people, including myself, are like, equal highs has to get hit. It's a magnet. Even at the end of the day, I thought this, right? I was still in my position, but I knew the type of trader I am sometimes, which is sometimes this, unwilling to take losses. So I didn't add any more contracts because I decided, right, how can I avoid being this type of trader, right? Average down using solid TA, right? Sometimes ignore the same TA, right, against my direction of bias. So the same concepts I use, smart money concepts, right? I'll ignore it against direction of my bias. I'll have kind of like visors on and only see the longs. In this case, I recognized that I was doing that, and in reality, if you look what price did, right? Price printed a market structure shift below this low, just barely. Then we came back into an order block, and we actually started to trade lower. So even though you can say like, okay, well, look at equal highs, you're ignoring the TA that got you this winning trade in the first place, right? This breaker, you went long, and you're targeting the equal highs up here. You got a winning trade out of that, but you were unwilling to accept that's maybe all you got. And you'll find that this is a very common trade, especially when you start averaging down. That was an example of averaging up, but you'll see, for example, there's lots of trades where you'll average down. For example, right here, you'll see a market structure shift, right? And a fair value gap, and you'll go long in this fair value gap. Now it's fine. Like this could be a losing trade, guys, right? It'd be a 20-point loss, and you would have been targeting this. This is a 1.65 2R trade. But what you'll notice is that the minute the market starts to bounce down here, even though you've been invalidated in this long, in this area, you'll be hunting longs again. Even though the thesis is already played out and you've been invalidated, you will marry the position or the thought of a long trade and then just start to ignore the signs against you, right? The signs against you in this case are going to be a market structure shift back to the downside and then an order block or a fair value gap, right? This area of the chart right here, you're just going to ignore that. And I used to do this religiously. So this is the type of trader which, if you're that type of person, recognizing that is half the battle. And you'll find that your equity curve, when you're doing this, is going to look like this. So you'll be winning, and then you'll take a huge loss because you're averaging down. Like you're taking entries, long here, then you're wrong, and you're like, oh wait, market's bouncing right here. I'm going to find another order block right here. And really, price has always been in a bearish trend now. You've been wrong, but you just married the other side. So how can you kind of mitigate this? These small wins and then large losses. And you'll see this very commonly in prop firm traders. And that's why prop firms use the idea of a trailing drawdown. because they know that your risk of ruin is essentially 100% if you trade like this. If you are unwilling to take a loss, all of this unrealized profit here, right, or all this trailing profit is going to hurt you so bad. Meaning you don't have to even come back and lose all your profits down here. You can actually lose if you just come back down to here in your equity value, because it's all trailed. That's the reality of prop firms. The trail and the unwillingness to take loss is what they're taking advantage of in how they price, trailing drawdown accounts. That's how they actually factor in their profitability as a firm, is by using rules like the trailing drawdown. So this is the characteristics of what I like to call a windfall or unwilling to take losses. Steady grinds higher and then elevators down. And it's usually the type of trader you become when you're a good TA analyst, like you're a good charts guy, but don't have the ability to say you're wrong. So let's take a look at why does this type of trader exist? Now, without getting too deep, I'm going to just tell you what I've learned personally, right? This is a bit of my own insights. Now, this type of trader exists for two reasons. The first reason is that this type of trader actually lacks confidence. In what? Themselves and their model. I'm going to say this again. This type of trader who is a good analyst usually lacks confidence. And that's something that's rare to think about. And until you start thinking about this type of trader, so this is the unwilling to take losses type trader. Until you start thinking about why you might lack confidence, you're not going to understand why you're able to, have 5, 6 winning days in a row. Your equity curve slowly growing. And then suddenly, right, you take this massive loss, you're stopped out of your trailing drawdown, and you're a good trader. You have a good model, but you can't execute on it. Or you cannot be wrong. And where does this lack of confidence come from? I'm going to tell you exactly where it comes from. It comes from doing a couple things. The first thing you're doing to become this trader is you're never giving yourself the time to build confidence in your model through reps. So you haven't ever followed the rules. And when I say the rules, I mean the risk management laws you set for yourself. And because you haven't ever followed the risk management rules you set for yourself, 1% risk, 2-to-1 R, stopping yourself out when you're wrong, actually being able to go like this, hey, I want to long this fair value gap, target this high, and risk this low, When you get down here, you don't look at this bounce and be like, okay, I'm getting back in. I'm going to average down. The worst type of thing you could do is start going long again here, and then start going long again here. That's not the type of trader that ever is profitable. You need to become the trader who follows your rules, accepts the loss, and does this enough times so that your brain starts to build confidence. Because I'm going to ask a question to you guys, I'm going to ask someone in the Discord, someone I want to see their name. Okay. Let's see. Moosey. You can type or you can come off your mic and show me how many days in your prop firm, right? If you maybe identify as one. Actually, first of all, who identifies with this type of trader? Anyone in the call wanna come off mic and say they identify as a type of trader? Thank you.
Yeah, for sure.
Okay, so trade chart game. He recognizes that he is sometimes this type of trader. I have a personal question for you. You okay with answering it?
Yeah, go for it.
How many days in your Apex evals do you have -100, -50, -200 days? Versus how many days do you have exaggerated losses?
No, I mean, it's exactly that. The red days are big, the green days are small. So it's when you're like the little steps up and then the big drop.
Okay,
yeah.
and there's nothing wrong with that, by the way. Like, if you saying that, you're the exact same way I was 3 months ago. In fact, probably 3 to 4 months ago, I was the exact same boat. I knew I could be profitable, right? Over the summer, when I started to finally become profitable, but I knew it wasn't my strategy anymore. It was 100% my mental. So I actually looked into the mechanics of why I was doing this, and dude, it came down to this statement. I lacked confidence that I could follow my own rules. So because I never gave myself an equity curve that looked like this, right? That's a healthy equity curve. This is some managing, right? A P&L curve over time, right? This is the time axis, number of trades, N. If you do this enough, your brain eventually starts to build a subconscious level of trust that you're not going to blow yourself out of the water. And in doing so, the amount of effort and work it requires to actually like follow your rules decreases. Meaning you'll just be more likely to follow your rules. However, by the same token, right? The trader who doesn't allow themselves to take the small losses, to consolidate, to maybe go down for a few days and then have a nice day. The trader who cannot do this, all their mind knows is this or this. They only know an up curve, like straight up, like lots of money. Or a loss that is essentially going to be the invalidation of their account, to quote one of my students. So one of my students the other day jokingly said, like, this trade is either going to go my direction or it's going to invalidate my account. Now, like, TCG, have you ever thought that? Like, when you're in a trade, have you ever thought like, okay, well, I'm full port, like, you know, I'm all in this trade, and either I'm going to win this or my account's gone?
Yeah, I mean, after the average down and you're already down $2,000.
Yep.
Yeah, you're just
and
like,
that's the thing.
Well, it's either gonna, yeah.
Once,
It's close enough.
yeah, TCG makes a really good point, and I'm gonna put another text box here. I'm gonna put an idea bubble coming off this. So, not a price. Once you violate one of your rules, your subconscious brain goes into caveman mode. Let me explain to you what I mean by that. When you're trading with a mental edge, meaning you have a precedent each time you place a trade that you will follow your rules, the second you sacrifice a single rule, whether it's averaging down, risking too much, not invalidating your trade, not taking the loss, taking 2 trades consecutively after a loss, your brain now resorts to a primitive level of thinking, which is essentially fight or flight. Now, this causes the revenge trading. This causes the over leverage. This really causes the thinking of how much can I make back or make? Not how much can I lose? What is the cost of this action? You don't think in terms of these statements once you violate a rule one time. Because when you are trading with a mental edge that's resilient, right, you take this loss. Like, you long this fair value gap right in here, you target this high, you take the loss, and you're done. I teach my students 1 trade, 1 shot, 1 kill, 1 session, and you're done, because you don't allow your brain to resort to this lower, intellectual capability or lower IQ, higher emotional response level of thought process, where you now are thinking, well, what's the next trade? How much can I risk? Maybe I'll double up the number of contracts I use to get back what I lost. Maybe I'll trade my P&L and not trade the chart. And it all comes from just violating your rules 1 time. However, on the other token, right, the other side of this coin is that if we understand that this mechanism exists when we violate our rules just once, what do you think is true about the inverse? What if we start to build habits? Okay. So the brain is just a series, right, of networks that learn, repeated actions. We can take advantage of this in the same way that working out for the first 2 weeks, right? Working out first 10 days, science shows, first 10 days is difficult, but then becomes progressively, exponentially easier, right? With time. So too is true of trading and following rules. Now, what I mean by that is that you can take advantage of this same biochemical interaction in your brain that causes you to turn into an absolute caveman brain. Revenge trading, over leveraging, thinking how much can I make? Where's the next opportunity? Oh fuck, I'm already down. Right? I was up here this morning. My equity curve, right? This was my equity curve. I was up here and then I took a loss. How can I get back here? Oh shit, I was here and I threw it away. Let me come back. Let me put more risk on. Let me do something. If I can just break even, I'll be happy and I'll stop. These statements are just because you don't have a set of systems ingrained in your neural network that say, I'm not gonna fucking break my rules and do that. So on the other side of the coin is what happens when we start to build good habits. We can take advantage of just following the rules, just taking one trade, just using manual stop losses and a 40 point, 60 point, 2-to-1 RTP. Over time, while we do this, our brains will habitualize with the rules coming first. I promise you, it starts off hard. And the hardest thing to do, the hardest part of becoming a profitable trader is fundamentally allowing yourself the time it takes to be wrong, to follow your rules, to honor the trading laws you set out. Once you can do that, right, for a period of a week, 2 weeks, 10 days, you will see that the difficulty in doing this goes down exponentially. It becomes a habit in your brain, and the chances of this happening also go down exponentially because your brain is just wired to follow the rules. It's your habit. It's like, yeah, you wake up in the morning and you might brush your teeth, you might make your bed, you might have a coffee. These things are going to become entrenched every single time you take a trade to just be like, okay, I'm wrong, moving on to the next day. Okay, I'm wrong, cutting my loss. But because you haven't done it enough, you lack the confidence. Not the conscious confidence. I'm not saying you don't have a great model. I'm not saying you don't have fantastic TA. I'm not saying you can't call tops and bottoms of markets. No, you can. You're a great analyst. You just don't trust yourself. Your brain doesn't trust itself to build good habits. So the minute you start sacrificing one of your rules, your brain goes into this desperation mode and everything becomes secondary. So another question I have for you guys here is, how many times have you taken a trade, right? It's been a losing trade. You've put on another trade immediately, and while you're in that trade, you know fundamentally that you shouldn't be in it. Like, there's a part of your conscious brain that's screaming at you to get out of the trade because you shouldn't be in it. Did that ever happen to anyone here? TCG, ever happen to you?
Sorry, I'm at work. Hold on. What did you say?
Have you ever been in a trade where you've taken a loss, immediately reversed your position or over leverage on the next trade, and there's a small part of your conscious brain that's telling you, I shouldn't be doing this?
I did that this morning.
Okay, so what did your like logical brain say when you maybe, for example, got stopped out and then you put on double the size? How did you feel? First of all, explain how you felt in your gut and your emotions. Like, what were you thinking at that time?
I call it going on tilt, if you ever played an old pinball machine, when you shake it, the machine stops.
Yep.
So it's like your logical brain stops working. And and then you're just trying to make the money back as fast as you can.
Yeah, so all you're looking at is your P&L, right? In fact, you're no longer looking at the chart at all. You're watching your P&L like a hawk, right? But what happens, right, when you get these moments of clarity where you're a good analyst. You can see, for example, that right here, price is starting to stagnate. Like, we're starting to lose momentum. You know this is wrong, but you're still seeing a negative P&L. You don't cut because at that point in time, you've already broken one of your rules. This subconscious caveman brain of yours doesn't understand all the logic that got you this beautiful growing equity curve over the past week. It only thinks in terms of max pain or max wins and max losses. And it's so detrimental. But the reality is, it's nothing more than a set of habits. And it's nothing more than building confidence, not in like profitability, but just in following rules, the ability to manage an equity curve over, 10 to 14 days. If you could, I always tell my students, if you have a prop account that's lasted 2 weeks, you're in a good place. Most people, the average number of days they have their Apex accounts for is like 4 to 6. Some people have their PA accounts for like 3 days, 2 days, and they blow them. Because you haven't given yourself anywhere near enough time to actually follow your rules for an extended period of time. And because of that, this lack of confidence is the only thing that drives your caveman behaviors. It's actually nothing more than that. And that's why I say build confidence in taking losses. So the confidence means that you can have a week that looks like this on your equity curve, right? So you were up, you were making huge wins. You were probably breaking your rules. Let's be real. To get to this huge win, you might have been risking way too much, putting on too many contracts. And the same way you make it is the same way you lose it, right? So if you're over leveraging to go up in your equity curve, you bet your ass you're gonna be going down over leveraging as well. But if you can have a period of your equity curve that looks like this, right? You are going to be a fantastic trader because managing losses over time, maybe this is like, a week or 2 weeks. This in here without ruining yourself is only positive. That's the thing. People think it's negative in terms of your balance, but it's only a positive thing because what you're doing is you're building this network, this neural network of repeated actions, and you're just saying, yep, I'm on a losing streak. Whatever. Profitable traders go through weeks, months, sometimes several months of losing streaks. And they're profitable because they know that these habits and rules are just how they trade. And they know that their brain is going to understand in all circumstances that that's how they trade. They're not going to violate their rules. Not ever. They're never going to risk too much. They're never going to overtrade. And the way you can get to this state of mind is by creating. So this comes into the next part then. So how do we achieve this? So how do we achieve this positive mental state of trading? And I'm not going to tell you any bullshit. I'm going to tell you exactly what I did. You are going to force yourself to follow your rules. How? Right? Use mechanical, unbiased systems. What does that mean? I'll teach you something. There is set and forget. Or my favorite, set and delete. Set and delete is the part where you literally open up your broker, set your stop loss and take profit, then delete the TradingView app off of your computer, off of your laptop, delete the broker app, do not look at it. Literally, come back the next day, okay? The next day, not session, the next day, and see if you took an L. Now, you might be asking me, like, why can't I still look at the position, stuff like that? Because you don't recognize that the only difference between your brain in, let's call it like state 1, which is the calm state, and state 2, we'll put this as a big red one, which is an emotional state. This is your calm, logical, rational state. The only difference between these two states, right, is one factor. That one factor is time. In the time it takes for you to recognize that the trade is over, you've taken a loss, you've taken a win, the emotional response associated with the trade decreases almost to zero. Meaning by the next day, this part of you can never be accessed. You are essentially what you're doing is when you're doing a set and forget or set and delete type of trade, you're starting your trade here. Always. Everyone starts their trading in this box. The rational, cool, calm head. For example, if I'm taking a trade, right? Let's say, oh, fantastic. I see this 15-minute order block. I see this 1-minute market structure shift. And I see this breaker block. I am going to get in on this trade right here. Fantastic. I'm going to enter right at the top of the breaker. And I'm going to target, buy-side liquidity. Great. I'm an ICT trader. This makes a lot of sense. Maybe I'll target, this high. I am not going to come back until the next day. And guess what? If I got stopped out below this low, which I would have been, let's see by the next time New York session opens. No, I wouldn't have got stopped out. So I would have come back and I would have had profits taken on my position. Say I got stopped out. I can't do anything. I'm severing, right? I'm literally cutting off this part, this connection to this crazy version of myself. There's time. The time has passed and I can't do anything about it. This part of your brain remains emotional, remains still problematic, but what you're doing is you're using a mechanical system to just say, sorry, man, I'm separating you from this brain with time. And you'll always have to contend with this guy here. This guy doesn't go away. Like, this person, this brain still exists, right? But you'll notice that over time, guys, as you do the set and forget, as you build the habits, guess what happens to the size of each of these brains? They do this, right? Your rational brain is rewarded because you know you took a good trade. So the next day, your rational brain gets bigger. And the next day, your rational brain gets bigger and stronger. And the connection between you and your conscious, rational, logical, good TA thoughts becomes emphasized. Because what you're doing is you're seeing good wins, but you're also seeing, without emotions, good losses. Guys, you're saying like, hey, I wanted to long this fair value gap, right? And maybe in this fair value gap that I wanted to long, I set my stop loss. My system is to set my stop loss below this wick. And I want to target this high. You're going to see the next day, I don't know why you'd set your stop loss here, but say you did, right? Right below that wick. You're going to see the next day, you got stopped out. But there's nothing you can do about it and price ran to your TP. All that's going to do in your mind is emphasize this part of your brain. Maybe you're going to start thinking, maybe I should adjust my TP next time. What's a way I can adjust my model to make it, better expectancy? All of your thoughts are going to be coming from this place. So this guy, your emotional, angry mind, doesn't have a chance to grow. It just kind of depletes. Over time, you just realize that there's no space for it. And because you're severing this connection each time, you're breaking it each day, you're not allowing yourself to even get into this headspace, eventually, man, like this entire connection between emotional and rational it just disappears. Like this connection, which is very, very vibrant all the time. The minute you get into a trade, right, you're feeling it. Trust me. You're lying to me if you say you put on this trade here and immediately you're not, okay, there's money on. I can feel it in my gut. I can feel it in my palms. I can feel it in my P&L curve. I can feel it. I'm feeling the trade. You don't give yourself any chances. This connection is just gone. It's just this. It's let me enter the trade, let me be rational, and every day, N is number of trades. It gets bigger and bigger and bigger, and eventually you realize that this part of your brain, although it exists, and you know what? It might stay the same size. You might have an emotional response every single time you put on a trade. Who cares, right? Who cares? When you don't have access to your emotional mind, it can't hurt you. In the same way that if I don't give you drugs, you can't take them. You are physically denying yourself this connection. And believe me when I say, severing this connection between emotional and rational thoughts while in a trade is the single best thing you can do to the fastest way you can become this type of trader who builds confidence. Because the confidence is going to come from doing what you've been doing. Remember, you're just a series of neural networks, right? You're just a series of repeated actions. Everything you do in life is repeated actions. Whether you're a person who procrastinates, whether you're a person who, gets their shit done, whether you're a person who's lazy or proactive or productive or who gives a fuck. Everything about you is defined by the repeated actions you do every day, right? Being successful is just a series of small actions that add up every day. Well, what you're going to do is you're going to give yourself the best chance of success in trading because this is all of the actions you want to be taking and this is all the actions you want to be avoiding. Just fucking don't let yourself get into that headspace. And like I said, this is definitely what I would call a band-aid solution because you're not addressing this guy. This red, angry mental, the caveman brain still exists. But if you don't give him a chance to thrive, he can't hurt you. So that's the first strategy. Is addressing the fact that you don't have control over your own thoughts right now. And that's okay because there's going to be more systems you can use, right, to adjust for that and slowly allow yourself to actually come into this big red emotional brain of yours and start to tear it down, make it weaker, make it less impactful in your trading. And these are some other mechanical strategies I suggest. So the first one is set and forget. By the way, The math for the risk of ruin and expectancy in trading, just so that I can spend more time talking about strategies, which is the most important thing, you can find right here. On my Twitter I posted a PDF called Risk Management. Now, this risk management PDF just actually uses a form of stochastic modeling called Markov chains, and what it does is it allows for independent events with known long-term probabilities to actually be calculated. And in this case, we're using trading with a defined, max drawdown of an account, which is 5%, i.e., a prop firm, and then you're going to be varying the risk you take with a 55% win rate and an initial capital of the prop firm, which is 50K, right? And essentially using something like a Markov chain, some people know this as Monte Carlo analysis. What you can do is you can actually find out what the optimal risk per trade is. And I did the math for you, and as you can see, even risking 1 to 3%, you have a 6 to 20% chance of liquidating your account. If you risk 4 to 6%, you have a 20 to 35%, and if you risk more than 6% per trade, over how many trades did I do this on? 100,000 simulations. So this is like very, very good data. It has a lot of variance accounted for. You'll almost more than likely to blow your account with trailing drawdown of 5%. So I recommend to my students, based on just this math, to risk between 1 and 3% only, which would be 1 or 2 micros, if that. Maybe 1 micro or 2 micros max. So the math's all there. You guys can check it out. Let me know if you have questions. I think it's more important that we keep talking about the strategies, because the strategies are really what are going to make us, much, much better traders. So the first strategy is just literally severing the connection between that emotional brain and that logical brain. You're logical when you enter the trade. Stay that way. Every day you see your model form. So let's say, for example, the next, let me just quickly look at a trade I might have taken. So look, I took this trade yesterday. I saw a smart money reversal up here using my model, and then I got in on, this breaker down here. What I would do is I would set my TP, right, using maybe this, I used this standard deviation projection. I would be like, okay, I want to target, 1.5 to 2, or maybe I want to just target low-hanging fruit. So in this case, let's target the first deviation. Okay, then I'm going to set my stop loss above this high. I'm going to walk away now and come back tomorrow. So I'd come back tomorrow and be like, great, I hit my TP. What would happen if I set my stop loss here? I'd come back tomorrow, right? I'd still be in the trade if I was a swing trader. But let's say eventually, look, I got stopped out. Fuck, man, I took a 40-point loss and it came 1 point to my TP. This is the type of shit that will cause you emotional baggage. Seeing this in real time. How many times, guys, did this happen to you? Where price goes 1 point to your TP, then reverses, and all you can do for the rest of the day is think about that. Come on, someone weigh in. How many times has this happened to you where price goes 1 point to your TP and then stops you out?
A lot.
What are you thinking in that moment? Can you think at all rationally in that moment? No.
I had the opposite happen today. I got stopped out by like 2 ticks before a big drop.
Okay. That's equally as tilting. So say for example, my stop loss was here and I got stopped out, right before it went to my TP. All that does, guys, is it opens the door for this huge emotional response. And that emotional response, by the way, will weigh on you for hours, days, weeks, months. You don't understand the amount of baggage that can hold in your mind. So what you're doing using this strategy is you're just severing it. No chance you'll get to feel that. Because, by the way, by the time you come back to the next day, because you've gone through time, right? Time has passed. Your emotional connection to this trade, which you took, 6-7 hours ago, it just goes down so much, guys. How many times have you guys been pissed off in life? You've reacted in a way you regret, and then you realize the next day, like, fuck, I shouldn't have done that, right? Because people are so incapable of separating mind over, mad over the situation. It's just large emotions in the time being. But our brains are fantastic at returning to a logical state, especially in trading. The next day, we approach the charts, usually with good TA. We don't feel the FOMO we did the day before. At least for me, I reset every trading day, but I don't reset intraday. And I realized this set and forget method was saving me, a tremendous amount of money by just severing that connection. The next thing I needed to do, right, was to actually address the beast. And this is my caveman mental. So what did I do? What are the strategies? One strategy is journaling. Now, I'm not going to expand too much on this, but there's 3 things you should be doing in journaling. You should be journaling your emotions before a trade, during a trade, after a trade. Just collect your thoughts. The simple act of writing down how you feel while in profit, while in stop, while in drawdown, when price hits your TP, when price hits your SL. The simple act of writing it down reduces your emotional response. It's been shown. The act of writing, or what some people call mindfulness or reflection, actually decreases the emotional response of a person. Because what it does is it engages the logical side of your brain simultaneously. So now you're feeling these things, you're feeling the emotions, but a small part of you, it might be smaller than your emotional response, mind you, when you first start, is actively, right, drawing from these feelings. These feelings are being actively mapped back to some logical standing. Meaning, how do I feel? Let me write this out. Let me communicate with myself and my mind, right? The left and right hand side of my mind, how I'm feeling. This reinforces the connection between emotional states, right? And logical states that are productive. This box in here is the productive journaling. This is something that over time will be the thoughts you remember and associate with your trade. You'll know how your brain reacts to drawdown. You'll know how your emotional response is contingent on trades, how a trade, how fast it goes to your TP, how slow it goes to your TP. If it's choppy like this, right? Like today, if it's chopping like this, how does that make you feel? As you reinforce this connection to some logical premise, like just logical thoughts, right? I'm feeling this, I'm being mindful. You're actually going to be diminishing the power this has to break your rules. Meaning, instead of feeling it and acting out on the chart, you're feeling it and acting out in your journal. So instead of being like, instead of being like order filled, reverse filled, stop filled, oversized, fuck, I blew my account. You're just writing down like right now I am in drawdown. I feel anxious, and a part of me wants to average down or cut early or revenge. You're gonna write this shit down, and by saying it out or writing it out, right, you're gonna be reading this and interpreting it with your logical mind. And your logical mind is going to be the one that builds good habits and reminding you not to act on the things you feel. It's so important, guys. I have a Notion template I can share with you guys. I'll watch the recording and send it later. You can start to journal how you feel during your trades. This is going to be imperative for reducing the emotional response while still recognizing it. Because ignoring the beast, like we did in the first system, set and forget, all you're doing is you're severing this connection, which is fine. It keeps you in a safe space, right? This right here is your home. And your home is a safe space. You're safe here. But this part of you needs to eventually be addressed. He still exists, and he's still dangerous. This is going to be slowly and meaningfully targeting this man. And this emotional dude is going to be decreased in power over time. Again, all of this over time leads to results. Not once, not twice, not 10 times, but 100 times, like 500 times. Do it. Everyone says to do it. Here's why. Do it and you'll see the results, I promise you. Okay, that's journaling. What else can we do to address the caveman mentality? What we can do is accept that sometimes he will win. And when he does, we need a strategy or something mechanical to stop his damage. Okay, what do I mean by that? Sometimes, no matter how much you journal, no matter how many times you tell yourself you're going to set and forget, you are going to fall victim to this larger, more emotional response. It will happen on the charts. It will happen in your life. We can't avoid it. We have to accept that there is a part of us as traders which will always be emotional. let's limit the amount of damage you can do to yourself. There's one thing I want you guys to do. Go into your Rhythmic. Go into your Rhythmic or Tradebate and set mechanical stops. Set yourself limits. So this could be max loss on the day, max trailing drawdown, max number of contracts, time of day you can trade. The number of people who tilt and then trade Asian session is absurd. Use these mechanical systems to stop the damage, because then you have three approaches that are working in symbiosis. You have one approach which is severing the connection, which is set and forget. You have another approach which is working on reinforcing a positive relationship between these, something that's going to be conducive to your equity curve in the long run. And the third is saying, sometimes I'm going to lose and sometimes he's going to win, and when he does, I have a max loss of $300. I have a max trailing drawdown of $500. I have a max number of contracts of 2 or 3. I can't trade Asia. I can't trade Asia. Right? These things are going to stop when this relationship becomes especially difficult to manage. It's going to stop this guy from tanking you because he is stronger for now. Over time, like I said, your brain that's logical is going to associate this response with the norm. And this emotional brain is going to become the much bigger player in your trading. It's going to eclipse all of the negative, impulsive things you want to do, but it takes time. So in the meantime, right, let this guy act out, but don't let him act out in a way that's going to hurt you. So I use mechanical stops to this day. In my Rhythmic, I have a max loss, I have a trailing drawdown loss, and I have a number of contracts, so I can't average down infinitely, right? Like, people, how many times have you done that? You just keep averaging down, you just keep over trading, right? Another great one that I recommend to my students is max number of trades per session. It's fantastic. I say, well, Niku, how many trades do I tell you to take per session when you're in drawdown? 1. 1 shot, 1 kill. Osaka. I say this is my famous quote. Literally, I say it all the time. You're going to take 1 trade with 1 contract using 1 model in 1 session with 1 pair. That's it. Per day. 1 a day. If you can do that, but you can enforce it through these things over time, that 1 shot, 1 kill, Osaka, right? This becomes what's associated with your trading. You can take advantage of this in your brain and your neural networks, which develop your habits. Just like you become a compulsive overtrader, you will become associated in reward with following your rules. The best way I can say this is that for anyone who's been through some form of like impulsivity control, whether it's like, they don't drink anymore, they don't do drugs, or maybe they were, spending too much time playing video games, you'll know that over time, if you can limit yourself to doing productive, positive things, the reward doesn't become the action that was harmful like it used to be. Like, the reward doesn't become the stimulus. It actually becomes overcoming the stimulus. So the reward becomes journaling. The reward becomes following your rules. What you do is you have a set of processes, right? These little dots, which are all isolated. And then you have this interconnected system of habits. And what you're doing in these processes is you're just strengthening the bond between all of these different things so that over time, this becomes interconnected, and these bad habits here, which you've developed, they become more sporadic. For example, if you're addicted to playing video games, you just don't play for like a month. Now the connection between your dopamine, right, like this huge rush of dopamine you get, and the video games becomes more sporadic. There's not this intense network that's wired to get you super stimulated whenever you play video games. But instead, when you do the productive things that you do every day, you're going to get this dopamine rush. So for me now, really, honestly, the biggest dopamine rush I get now is posting my trade recaps, being active with my students, being active with my community. It's not really winning trades or making money. It's following my rules. Because I feel like when I go into my journal at the end of the day, and I have confidence that I'm not going to break my rules, and I can put down in my journal, here's another day. I have tallies, right? Here's another day I followed my rules. I can see how many days are building up. And eventually, this gives me a lot of dopamine. Like, seeing me have Apex accounts for a month or 2 months without blowing them actually skyrockets my dopamine, as opposed to this, really negative habits like overtrading, gambling, revenge trading, putting on too much leverage, which give you these short-term spikes, followed by these really drastic lows when, they hurt you. Reinforce in your mind what positivity and dopamine is being released for, and do that manually. Don't assume it will happen. Set the limits, set the mechanical strategies, and then let your brain build up this positive mental attitude, right, over time. And you will be so shocked with where you can grow when you have the intervention of some really like tangible strategies. So, to review, you're going to set and forget. The first thing you're going to do is set and forget, because at first you got to tame that beast and just disconnect him. Disconnect that emotional mind, set and forget. Then don't forget that he's still there, and if you want to be profitable, you will have to address him. This guy cannot exist like this forever. Journal. You're taking his power away. You're giving your conscious, rational mind a chance to talk yourself out off the cliff. Right? You're on the cliff. You're here, right? You're here, and you're thinking like, I want to trade again. I'm going to use more leverage. I'm going to reverse. And then you start writing these things out, and what your brain tells you is, no. Stop. For 1 second, stop. Stop doing and start thinking. Start typing, start journaling. Write it out by hand. And eventually you're going to be like, okay, I'm not going to do that. I'm just going to write it out. That's how I'm feeling. And this part of you still gets that hit. You still get that hit of thinking all those things. You just don't act on it. And then sometimes accept that you're going to act on it. You're going to fuck yourself over. Have the last resort mechanical stops that are going to help you. I have all of these things in some form, guys. I have a max loss. I have a max trail. I have a max contract. I used to do time. Like, I couldn't trade during Asian session or before a kill zone. I've done it all. I've struggled very immensely with this part of myself. These are the strategies that work. So if you start doing these things, you'll have success. So that's it. Don't overcomplicate it. There's 3 strategies here. Do these 3 things. Ignore all the rest of the noise. Recognize that there's a reason why you're dealing with these things and you have these thoughts, and it's because of your habits. Use these things to build good habits, and over time, you're not going to violate your rules. These subconscious brains are going to be reduced in terms of their impact, in terms of how they tell you that you lack confidence, and you're just going to be a trader who follows rules. And if you do that, you're not going to be the unwilling to take losses trader. You're going to be the trader who invites losses. You're going to think as every loss as a day you get to add another check. So say you have a tally, right, in your journal. Every day you follow your rules. Oh, good. I took a loss today. Great. I took a loss today. Great. I took a win today. Great. I took a loss today. Great. I took a win today. Great. See what I mean? Over time, this becomes the reward. The P&L curve is going to do the P&L curve, guys. Like, you guys know, we have profitable models. You need a profitable model, go watch my YouTube. Like, you can learn how to make your P&L curve look like that. Look like this. Look like this. Whatever. Long term, you're going to be trending higher. All you have to do is stop associating the reward with these up days and start associating the reward with every day. The down days, the up days, the in-between days, the consolidations, the expansions in your equity curve. Make the reward going into your journal and just adding another day of you having an account. This eventually will stack up, and this will become the reward. So yeah, that's essentially psychology and risk management. All the math and stuff you guys can find in my PDF, but this stuff here is really these concepts reinforce why people say risk 1 to 2%, size to lose. These are just heuristics. Heuristics are just something that people say, but they don't really mean anything. Like, you can't just say, oh yeah, I'm in a size to lose. I'm in a risk 1 to 2%. No. You should risk 1 to 2%, and here's how you're going to force yourself to do that. You're going to journal. You're going to set mechanical losses, and you're going to set and forget. Do these things. These heuristics will become second nature to you. Over time, you're actually going to become a trader who is not this trader. You're not going to become the unwilling to take loss trader. You're just going to become the trader who grows your equity curve. All right, sounds a lot of talking. Any questions? Anything at all about how I manage risk, strategies? If you agree with these systems, if you don't.
That's great, man.
Good?
Yeah, good stuff. I appreciate it.
All right, no worries, guys.
And you post recording to YouTube, you said?
Yes.